Good morning, student. Today we are going to see the risk management, basis of risk management. So we will help you to understand what is mean by risk, what is mean by financial risk, what are all the major classification of financial risk, and we will give you the brief of each type of financial risk for your better understanding. This is more of a basic information one should know before you start reading any risk management subject. Right. So the first we will see what is mean by risk management or what is mean by risk. The people always feels that the risk means making losses, right? But risk is nothing but is not only making losses. Anything which leads to uncertainty, it is called risk. We always give the classic example in a student in a classroom where a student who is scoring 90 marks, there is another student who is scoring a 10 mark. We will always ask who is risky. The most of the participants gives the answer, the student who is scoring a 10 mark will be a risky, right? But the point here is we cannot just like that say the student who is scoring a 10 mark is risky and the student who is scoring a 90 mark is not a risky. What we need to try to understand here it is, there is an average mark in the classroom. Probably, if you are taking it, 40 students in the classroom, 30 students who have scored anywhere between 60 mark to 70 mark. 5 students who are scoring more than 85 mark, 5 students who are scoring less than 20 mark. In this case, what I given the example, our average is around 65 mark. There are one side, there are students who are scoring 90 mark. There are another side, there are students who are scoring 10 to 15 mark. Here the risk is lies the student who are scoring at 10 to 15 marks and the students who are scoring at 90 mark. As per me, both the side, that means we call it as a extreme ends, are risky. You can ask me what is the risk with the people or the student who are scoring 90 mark. Please understand that in this case, the student who are scoring 90 mark, that portion is only a 5 student out of 40 student may not able to continue in these classes or in the school because they feel, they may not be in the same peer group. There is a possibility of losing the student is there. Let me come back to the student who are scoring at in the range of 10 to 15 mark. What they will do is they will pull down the averages. So any risk management, what we can see is overall the people who are in both the extremes, the student who are at lower end, the student who are at higher end, both are risky. So who are not risky, who are at the average. Those who are on the fit into that average line is not risky. So how do we define the financial risk? The risk is nothing but how much we are deviating from the mean. So that is called risk. Your mean is 50 mark. Your deviation is 90 mark means 40 mark above average. If somebody is scoring 10 mark, the student who are scoring 10 mark, which are deviated from the mean is 40 mark. The more from the deviation, higher the risk. So that is the reason the organization will always take your 10 standard mark, 12 standard mark, and college mark to see whether you are a consistent performer. If you are consistently scoring 65 to 70 mark, absolutely no issues. Suppose if you are scoring 10 mark in 10 standard and 12 standard you have scored 90 mark, and again in a college you have a two subject area, that means you are not certain, you are volatile in terms of performance. Anything which leads to volatility in performance leads to risk. Anything which leads to uncertainty, it is defined as a risk. So what is meant by risk? How much we are deviating from the mean or how much we are deviating from the average, it is called risk. Right? So if someone has asked you what is meant by risk, please don't tell us somebody is making loss is a risk, or what you need to define as risk means volatility. Risk means uncertainty. How much we are deviating from the average, how much we are deviating from the mean. That is called risk, right? So whether to manage risk or not, my answer is to manage risk is a primary importance of any person in the world, right? It's not only necessary he has to work in a banking to manage risk. So anything and everything in this world has got certain element of risk. So everyone has to manage the risk. So managing risk is a very important in our day-to-day life. It's not only in financial side, it is on the day-to-day life. The managing risk is important. The more you are ability to manage risk, you can make more money. It is a simple concept. Somebody comes and asks me, sir, how to make more money in my life? Simple. Take more risk, manage those risks. I'm just clearly saying, take risk and manage those risks. If you are able to take risk, if you are ability to manage risk, you can make money. It is a simple, plain vanilla language, right? So the financial risk is nothing but managing uncertainty in the financial market. Right? I will repeat again. Financial risk is nothing but managing uncertainty in the financial market. Okay. The financial risk has been classified into multiple ways, but I will explain you in a smaller portion of the financial risk, because the financial risk itself is a subject in nature. But today's session, I will explain you the basic understanding of financial risk. Right? So what we will see is we will go through and see a certain classification of a financial risk. All right. Let us see the financial risk, the classification. Here I have given you the entire classification of a risk. Right. But in today's session we will see two major risks which we can understand that. Okay, so let us understand the financial risk portion alone. All right. So I have classified various risks here. Right. We have a financial risk, operational risk, legal risk, business risk, and liquidity risk, etc., etc. But today's classes we will see only the financial risk. Right. So the financial risk we will have two major component. One is market risk and credit risk. Right. What is market risk? Market risk is nothing but the unplanned event in the market which leads to the fluctuation of the market prices. Please remember what is meant by market risk. Market risk is nothing but is an unplanned event in the financial market which is leads to a financial fluctuation on the prices, or unplanned event which leads to the price fluctuations in the market. If it is the equity market, it is called equity price risk. If it is in the commodity market, it is called commodity price risk. Simple. So anything which is fluctuated on a day-to-day basis, on hourly hour basis, on a minute-to-minute basis in terms of a pricing, that is called a price risk. But if it is related to equity market, we call it as equity price risk. If it is related to commodity market, it is called commodity price risk. If it is related to foreign exchange, it is called foreign exchange risk. If it is related to interest rate linked to a specific asset, we call it as interest price risk, right? So the broader classification of financial risk into a two major component, one is a market risk, another one is a credit risk. What is market risk? Market risk is nothing but the uncertainty prevailing in the financial market, right? That is called the price fluctuation in the financial market. For example, if someone knows the price is continue to move up, that is a secured investment. Or if someone knows if the prices continue to go down, they will not invest in market. But the market don't behave like that. We are not able to predict whether the market to go up or go down. That is called risk. The unpredictable behavior of the market is called risk. If you are able to predict the market, there is no risk. But unpredictable behavior of the market is called market risk. So the market risk has been broadly classified into equity price risk, commodity price risk, interest rate price risk, and foreign exchange risk. So as I told you, if the price risk is associated with the equity market, it is called equity price risk. The price risk is associated with the commodity market. It is called commodity price risk. If the price risk is associated with the interest of a specific asset, it's called interest rate risk. If the price is associated with the foreign exchange, is called foreign exchange risk, right? So the other part of the financial risk is called credit risk. What is credit risk? Credit risk is nothing but the risk of default. The credit risk is nothing but is a risk of default, right? If the bank is giving a loan to a someone, the someone or a person or a borrower who borrowed money not able to pay back or delayed payment, it is called credit risk. The credit risk happen because of the various factors, because of the poor credit rating of the party, or inability to make the payment on time, or because of the environmental or economical or political condition making the party to default. So the factors may be different, but all are called credit risk. The credit risk is further classified into portfolio concentration risk, transactional risk. All are different aspect of credit risk. Probably that can be discussed on the next class. But to summarize today's session, the financial risk is nothing but unplanned event which happens in the financial market or banking industry or the financial sector, which leads to a uncertainty in predicting the cash flow. That is called financial risk. The financial risk is broadly classified into market risk and credit risk. Market risk is associated with the market. Credit risk is associated with risk of default. Okay. So what we will do is, in the next section, I will give you a detailed understanding on market risk alone. Then the separate section can be made for credit risk, and then we can see another risk called operational risk and associated risk with related to financial market. Thank you so much. And any queries, please WhatsApp. Thank you.